Hello, everyone. Welcome to Multifamily on Zoom. As always, we appreciate you being here. And for those who are new here, this is a space where we come to learn, go, and make better investment decisions together. No fluff, just real conversation that move us forward. And today's conversation is one of those you don't want to miss because right now the market has not slowed down; it has shifted. And one of the biggest shifts we're seeing is in lending. Today we invited Eric, and as you know, Eric been always gracious to come here and other platform as well to educate us and let us know what's going on. And I think what I like the most, and sometimes it's certain things we don't even expect or we don't know, and then it, if you are part of our mentor group, he will go ahead and put a little update for us. I mean, Eric, you've been so generous with your knowledge. You've been pointer to some of us. You also have been in that I mentor community. I wanted to take that opportunity to say that as Dave is retiring, you also been a lender for us. You also been a friend, that advisor. Because I remember last year I was going through that deal and I don't know how many phone calls I have to give you. And you also been a partner with many of us in the I mentor community. And we really want to thank you for that. And we want to welcome Eric here this afternoon and every single one of you as well for being here as he's going to dive into um, those questions that we may have. And I want you to understand this is a Q&A. And since this is a Q&A, make sure you guys ask as many questions as possible because that's what we hear. We don't have a presentation. It's just a Q&A. So welcome, Eric. And today I am not going to do an introduction. If you like to do one, you're welcome to do one, but we welcome you to Multifamily on Zoom one more time. Thank you for being here.
Well, thank you for having me. I really appreciate it, Susie, and I appreciate everybody on the call giving me a couple minutes to kind of really just put myself out there. Susie and I talked about it earlier, and I didn't prepare a presentation. I didn't prepare a slide deck, um, and that was intentional. That was intentional so that we could mix it up and make sure that you leave with the information you want, rather than just me putting a stale presentation together and rambling on, and then we burn 45 minutes thinking we accomplished something, and maybe we did, maybe we didn't, right? It's better to just mix it up and ask questions that come to mind, but there still needs to be some type of skeletal structure. So what I'm going to do is just kind of work from notes and a high level structure where we're going to talk about historically what the SBL program was, so we can get a foundation for that, kind of reaffirm what we've talked about in the past, and then compare the two, the small balance loan program that is no longer, to the small conventional program, or conventional small, technically, that they're working with now, that Freddie Mac, and this is all compartmentalized with Freddie Mac. And then we'll talk about the pricing changes, a little bit of the leverage tweaks, timing through the process. The closing costs are actually spelled out in the bulletin. And then a little bit more about borrower qualifications too, and how that's going to kind of change a little bit because, I mean, the SBL program has been an institution in the industry for such a long time, and it's really helpful to have that, or has been very helpful to have that structure, not only with the loan program that we knew we could get or we knew we couldn't get, but also with like market tiered pricing. Previously the SBL program, they took their pricing models, and they had four specific types of markets. They had a top market, they had a standard market, a small and very small. And then as you reduced your market size, the pricing went up, and maybe the loan to value went down from 80% to 75. The debt service coverage ratio would increase as the leverage goes down. So it was really nice to have that structure. But with that structure came some struggles. And one of the really nice features of the SBL program that was great for us, but a challenge for Freddie Mac was the fact that they would hold your interest rate from where it was at the time you made application. Now, many of you are familiar with what we call a rate lock. And with Fannie Mae and Freddie Mac conventional, larger Freddie Mac deals, we don't lock rate until right before we close, 3 to 5 days before we close. And your interest rate fluctuates the whole time you're in process. Well, with Freddie Mac SBL program, they would hold that rate when you made application. And it was really, really a nice feature because you had that peace of mind to know where your rate was going to be. Well, what happens when they do that is, let's say you're doing a $4 million loan, they're holding your rate grid for that $4 million, and there's an expense associated with it. It's not free to do that. And without a firm commitment from the borrower at application, there was a lot of folks that would pull out of the deal. One, intentionally pull out of the deal. Two, maybe the property performance changes during that time and the deal would fall out, right? So for various reasons, they were holding interest rates for borrowers that didn't end up closing. And that was a major expense. Another area too is Freddie Mac Conventional has always looked at the small balance program as kind of a loss leader, kind of a necessary evil to serve the smaller multifamily properties. And they've just looked at it kind of as no, I won't say negatively, but it hasn't really been accepted through the conventional program. And so for all those reasons, I'll say they did away with the SBL program, but they did replace it with kind of a hybrid of their conventional program and what SBL was. And as you guys know, it's referred to as the small conventional or conventional small. And the loan amounts are between 2 million and 10 million for this program. Now, you guys all remember that the SBL program was between 1 million and about 750,000. They actually took it up to 9 at one point. But what that does is leave a hole in Freddie Mac's program for deals between 1 million and 2 million. So it's kind of interesting because you're going to see a shift where those smaller deals over 1 million but under two, if you're going to go agency, they're going to have to go Fannie Mae with it. What that means, it's just Fannie's going to see more volume in that market, or in that space. You know, it's manageable. There's not a ton of deals. I don't know the number, but the majority of the deals that we're going agency, we're going to be over that $2 million mark anyway. So I don't know that that's going to be as impactful. Another thing is deals below 2 million were getting priced up. They were very expensive. And we're talking spreads of around 300 basis points, maybe 270, maybe 280, sometimes over 300 basis points, depending on the market. So in that scenario, that $1 to $2 million space, you're talking high 6% with treasuries in that 4% range. And it's not as cost effective as a lot of other lending sources out there, especially with the debt funds coming into play for those smaller deals. One of the things we'll talk about later on, but I'll just throw it out there now, is they are leaning into that 5 to 50 unit space still, which is interesting because that would be considered smaller properties. So you kind of have to re-engineer it to see where the sweet spots are going to be. And this is based on a couple of factors. One is they claim they're leaning into 5 to 50 units that are 5 to 50, right? But they're also implementing a standard for a minimum of a 10% underwritten vacancy on properties below 30 units. So what does that say to everybody? That's going to cripple a lot of the cash flow, the underwritten cash flow on these deals. That these properties might be running at 5% or eight, let's call it 7% occupancy. They're going a minimum of 10%. That's going to reduce that underwritten cash flow and their ability to qualify for a larger loan. So there's going to be an odd bucket or an odd mix there that's going to decide whether Freddie Mac's the right play or Fannie Mae is the right play. And it's something that we're going to have to analyze each time. We do it now. We always assess whether Fannie's the best route or Freddie Mac's the best route. But it's just going to be a little bit more detailed as we go through this. So that's one area. Does anybody have any questions as I'm on some of these things that I'm bringing up? I'd love it if you guys could just jump in and start hitting me
Yeah.
with the as we go, because I'll
Yes.
sometimes I'll say something
Yes.
and blow past it, you know.
You can go back to it. Guys, go ahead and raise your hand if you have a question. That way you can just ask your question directly. But uh really what's really driving these changes in Freddie Mac right now? Why, I mean, you just mentioned that 10%. That's a to me that's a huge amount and that's gonna really affect uh
Well,
us like trying to get that loan
yeah,
and
I was
putting
hoping
up.
somebody was going to ask about that because it's interesting, and it's something that I ask my clients to do outside of what the agencies or any lender is asking for. I ask my operators to really consider this too. And you know, Jerry, you could jump in on this, man. With a property that's under 30 units, right? How easy is it to hit 10% vacancy? It's a lot easier than when you're, say, 100 or 50 units, right? It's easy to get there.
That is
So
true.
the likelihood of you being at 10% or more on a property that's under 30 units is much greater. So to me, that really makes sense. And it aligns with, in this market too, with flat rents and higher vacancy across the board going forward. And this wasn't the case necessarily 2 years ago, but going forward, I think it makes sense to underwrite a minimum of 10% on those smaller unit properties, just because it's so easy to hit. Does that resonate with you guys? Nice, nice. So that's
Well, if you're conservatively, you really need to do those things because not only that protects you, but also help with your underwriting because not having that cushion just in case it happens, because it may happen, especially right now the way the market is, and you don't want to be in that situation and get caught off guard. So having that little cushion is always good as a conservative underwriter to always follow those rules. I know everybody underwrite differently, but you have to have certain measures that will keep you just in case something happen.
100%. And you know, the you have to be careful too about the cautious underwriter that kills every deal and never buys
That's
anything.
true. That
You
is
know,
true.
it's always this badge of honor to say we underwrote this conservatively. It's always a badge of honor to say the old adage that everybody says, well, we want to underpromise and overdeliver, right? How many times have you heard that, right? So there's always a blend of making a deal work and being realistic, and then also leaning to that conservative side. Um, it's funny because we say, oh, we want to be conservative and we want to under promise and over deliver. But in that same conversation, I hear everybody say when we see the returns aren't where they need to be, they always follow up with, well, let's work on this deal a little bit more. Well, what does work on the deal really mean? That means get a little more aggressive in your underwriting or your operating projections so that that return goes up and you can
Goes
sell
up.
it, right? And
Right.
they almost work against each other. What does work on a deal really mean? So just I don't know, some insight into these conversations that we always have. I think it's well deserved because especially now, um, it's hard to raise capital out there. There's so many LPs, so many deals have gone south and LPs that that have lost money. They're now
Right.
coming, they're
We
now
getting
coming.
there. We
Yeah,
are getting there. That's the question that I have. But let's go this one right here. But for what you were saying, I think a lot of people say they are conservative, but at the end of the day, you have to learn as an underwriter or as a team to balance. That's one thing. And then secondly, being creative. Being creative is one of other way you can make a deal work. And we're not saying creative to make that deal work in order for you to get that deal and compromise the money of your investors. being creative will realistically, other words, just trying to balance both ways because right now you have to be very, very creative to make most deals work. From your perspective, Eric, what's the biggest shift in lending over the past 12 to 18 months right now?
I heard biggest and then 12 to 18 months, but in the middle, it jumbled up
Biggest
on
shift,
me.
the biggest shift in lending.
I can't say the biggest, I can't quantify it as the largest shift, but I will say a very, very notable shift is each one of our lenders is taking a heightened interest in their property quality and the quality of the assets in their portfolio. They're increasing their site inspections. They're increasing the detail of what they're looking for, especially on older vintage assets. So deal quality is big. Another component is digging into borrower financials and borrower experience and verifying all of that information. So somebody that's never done business with an agency before, they're going to have to put up tax returns, not to analyze your income, but to look at your K1s and compare the percentages from your K1s to your schedule of real estate and see that you actually own the percentages that you own. So there's a heightened concern there too. Back in 23, there was a brokerage firm, a commercial mortgage brokerage firm, that did a ton of cash out refinances with Freddie Mac, small balance, and Fannie Mae, and they falsified a ton of documents on behalf of the borrowers and pulled a ton of cash out. There was um, title companies were involved, and there was the borrowers didn't know anything about it, or a lot of the borrowers didn't know anything about it, and they obviously Freddie Mac uncovered it through their auditing the financials, and that really changed the scope of the market. For me, it was kind of nice because they made transparency more of a standard to want to connect with the borrowers and really they may have to maintain that email chain with the borrowers through the process, which is something I like to do anyway. Um, for me, it's a big deal to get in front of any lack of understanding or get in front of any how can I put this questions that my clients have on their investment strategy and how their loan works with that investment strategy and get in front of that early on. So I have no problem with putting my clients up in front of a lender and having us all talk through things. That's what lender language does too. My whole platform that I have, that's what it's all about is building better borrowers. And I do that so that we close loans, right? That's kind of the whole point of it is get in front, educate, and then now we build better borrowers that are going to close more loans, which we close more loans, everybody wins. Um, so yeah, those are two of the biggest shifts I see are really leaning into asset quality and also verifying borrower information.
But would you say we are in a tighter lending environment or in a different one or just a different one?
Here's what's interesting with that. Yes, I would say it's tighter, but it's not necessarily lender driven. I feel that it's more cash flow driven than anything else because they're using the
Right.
same formulas, the same DSCR formulas of 1.25, 1.35, so forth. But the deals are not cash flowing for the requested loan amounts like they were, right? I can tell you on one hand the number of full leverage loans that I've been doing because deals just don't cash flow for full leverage right now. They don't make enough money to support an 80% loan to value. And I won't say that's because prices are high. I'll say cash flow is lower, expenses are very high, rents are
Yes.
flat. So we're just
True.
in this, there's always an ebb and flow between expenses, between rents, between valuations, cap rates, and so forth. And we're just in this spot right now where rents are flat, expenses are up, rates. I mean, we'll talk about rates in a little bit when we get into pricing on the small program, but the reality is I know everybody's saying, oh, I want to wait for rates to come down, and I don't think they're going to go much lower, right? We're going to see this trading range of high threes to low fours in the 10-year. If it blows above 4.5, that's going to be a ceiling. But realistically, a 10-year treasury between 375 and 4.25 is a very reasonable trading range, especially with where Fed funds rate is. Um, it all works to this level. We're all conditioned to property valuations and interest rates being artificially low, right? That was fabricated. That was artificially low. And so that created these artificially high valuations. And I'd love to see rates drop a little bit just to kind of ease us out of that artificially low environment, kind of like detox off of that drug of a low interest rate, right? Because if you just go cold turkey, it hurts. So maybe we could just have a mimosa or maybe a Bloody Mary on the way out on a Sunday morning, and just ease off of that low rate hangover that we all had. It would be nice to see that instead of just bump back up to, a 4.25 treasury and stay there as a baseline. So
Right.
that's what I see. I don't see this credit tightening where lenders are they don't want to do deals. I see lower cash flow where deals don't support the loan amount that we're asking for still.
Yeah, I see a lot of people talking about that on LinkedIn as well.
Yeah,
The cash flow is the issue right now.
it's a real
So
thing.
go ahead.
It's a real thing. And also occupancy, you know, 85% occupancy on these conventional programs and 90% occupancy requirements on Fannie Mae small balance. Hey, a lot of deals, and it's kind of like what we started the conversation with, a lot of deals are below 90% occupancy right now. A lot of them,
That's true.
especially the older vintage, because everything is ratcheted up a little bit. When rates come down, people can afford a higher class of an asset. So everything kind
Yes.
of ratchets
They
up.
move.
And so
Yeah,
your
they move.
your early 70s, late 60s vintage assets, they're feeling it. They're feeling it. There's a flight to quality right now.
Yeah, but what do you think, Jerry, I'm gonna go there. I was gonna ask you that question later. So what's the future for those vintage? I mean, they are there. What do they do with them? I was in a summit, I think a few weeks ago, and we were having the same question. So what happened with those vintage?
They
Because
have
the people who have them want to sell them, buyers don't want to purchase them.
they
What's the
they
future for that?
they have to low it's about cost basis and needed renovations and needed updates to maintain their competitive spot in the marketplace. And when you buy a property like that, you have to look at what you're going to have to do to it, not just the purchase price, but your overall cost basis and your yield to cost rather than just cash on cash return.
That is so true. Go ahead, Jerry. You muted.
You sound
We
great.
cannot hear you. You muted.
You never heard you sound better, man.
Sorry, I'm still getting over a cold. You guys don't need to hear me coughing. Um, Eric, you mentioned a lot of Fannie Freddie's, small balance issues. Would that still be the better route to go versus a commercial bank depository loan?
It has everything. It's a great question, by the way, and it has everything to do with your risk tolerance. The majority of the depository lenders, the majority of them. Now, there's always lenders out there that lean into the agency style, and we have one, right, on one of our deals. But most of your depository lenders are still looking for recourse loans. They're still looking for a recourse guarantee. A lot of them have not adopted a 30-year amortization yet. And many of them don't do interest only unless there's a major renovation component. So, depending on what market you're in, depending on the deal specs, that depository lender or that credit union may not be the right source because their loan programs don't fit into what you're looking for or your investment strategy. So, um, they can be a great source, and especially under that $2 million mark, you're going to see a lot more business go that direction. But the agencies and the value of that agency business is still very much very viable.
Thank you.
Sure thing, man.
Okay. Um, when it comes to the program itself, what are the key differences between the old program and the new one?
Okay. From a pricing standpoint, and this is I'm glad you asked that because it kind of we can compartmentalize that into different sections. We can compartmentalize it into pricing, loan to value, timing, borrower requirements, all those types of things. So first, from a pricing standpoint, the old SBL program was almost a point higher than your conventional deals, a half to a point higher. And now you're seeing with the morphing this small balance with conventional, they're going to tighten that spread up a little bit. And these deals that are 2 to 10 million, let's call it 2 to 6. Let's call it 2 to 6 because they were giving above 6 million, they were giving conventional pricing anyway. Um, you're going to see maybe a 30 to 50 basis point spread. So you're going to see better pricing on this $2 to 6 million. 6 to 10 is still going to be similar pricing anyway. But that 2 to 6, you're going to see better pricing. The leverage is going to be very similar, right? They're still doing 80%. And the baseline of that 80% loan to value is going to be national, right? Previously with SBL, if you were in a small market or a very small market, population under 100,000 or I think 300,000 on the small, you were at 75% max leverage, right? So nationally right now, the small conventional is a 125 cover at an 80% loan to value. That's maximum leverage. Now again, this is the lender language thing. This is something I talk about all the time. You have two approaches to your loan amount, right? You have your leverage constrained approach, which is 80%, the maximum they'll give you. And then you have your proceeds driven approach, your cash flow driven approach, which is the maximum amount that loan amount will support. So leverage is, hey, we're capping it at 80%, no more than that, or capping it at 75%, no more than that. Proceeds driven, we're going to give you as much as we can, but we have to make sure that you cover your payment at a 25% margin. So what it boils down to is if your mortgage payment is $10,000 a month, the net operating income of that property has to be $12,500 a month, just to kind of make it super simple. You have to cover it at a 25% margin. With this small conventional now, you've got a national program at 80, 125.80, whereas before it was very compartmentalized. Now we were standardized and it was nice to know where we stood. But now it's kind of wide open on a national market. Where you do get dialed back on your leverage is on your shorter terms, 5 years and 7 years. This is important because it's a fundamental in our industry where your lenders have different tools that they use to protect themselves. And the most powerful tool that they have is leverage because they don't lose what they don't lend. So if they do an, let's say they do let's say they do a $5 million loan for you and it's 80% loan to value. Well, that's maximum leverage for that program. If there's something, if there's something quirky about the deal that they don't like and they charge you an extra quarter point, well, that's just an extra quarter point that you're not going to pay if the deal doesn't work out. But if they only loan you $4 million, well, that's $1 million that they're not extending. And that's money they didn't lose. So that's the most powerful tool they have is leverage. And what they want to make sure of is that you can pay this thing off. One, you can make the payment, but two, you can pay this thing off. So on a 5 year term or a 7 year term, you have a shorter window, a shorter timeline to pay that loan down. So if let's say the first 2 years of these loans are year, 2, 3 years, the first 1 to 2 years are interest only. Well, that leaves 2 years less that you're amortizing that loan and reducing that loan balance and lowering the risk of your ability to refinance. So the exit test is really, really important on this. And they keep that close to the vest. They stay very proprietary with their exit tests. But that is why you're going to see maximum 75% leverage on partial IO deals, right? So if you're looking at let's say you're looking at a 5-year term and or yeah, let's use 5 year as an example. You're because they do 5, 7, 12, and 15. If you're, let's say, between 5 and 7 years, you're going to get maximum loan to value of 75%. And it's got to be a 1.25 cover. If you are looking for full term interest only, like the whole 5 years or 6 years or whole 7 years, right? If you're looking for a term that is if your interest only period for the whole time, they're not going to go more than 65% because they want to make sure that when that loan matures, you're able to pay it off. And they don't want to have a loan greater than 65% when it's time to refi, just to protect their exit. Now, if you take a term that's greater than 7 years, you've got a longer time for that deal to appreciate, and they'll go up to 70%. So 70% full term IO, as long as your term is over 7 years. So that's one to hang on to because full term IO is really nice. I've got a 60 unit in Texas, and we did a 10-year term, full term IO. Really sweet. It's been nice just because it was a refinance. We purchased it with bridge debt, refied full term IO, pulled some cash out, and now we're sitting with a low debt service, and it's a nice deal. So as long as you're okay with the leverage, that full term IO can be a really nice feature. Um, Something else too, that to compare these things are timing. I don't buy it, frankly. They're saying that this small conventional program is going to be a couple weeks faster closing than what the SBL program was. I I speculate on that. I really believe it's going to be the same. Because when we were doing SBL loans, they were supposed to be faster than conventional. Um, I don't see it happening. So that one, they're going to have to prove that one to me because I think it's going to be just as long. Freddie Mac is interesting relative to Fannie Mae because Fannie we all know, has the program that we all know called the DUS program, Delegated Underwriting and Servicing. Okay. They let their licensed lenders fund these deals, right? As long as they work within the confines of that DUS program, that Fannie lender can go out and fund these deals and they buy them after they close. Well, Freddie Mac requires that they review everything, they issue the application, and they kind of control that scenario. So even on their conventional side. So I don't see how it's going to be faster. They say it will be, but I don't think it will be. I think it's going to be longer or maybe the same time frame. So Mike had a question.
Yes, Mike has a question. Go ahead, Mike.
Hey, Eric,
Hey man.
you just talked about paying interest only loans, right? So you pay interest only for a while, right? Now, and there's a reason I'm asking this. This is how people get in trouble right here, right? Doing this because they don't underwrite it correctly in the beginning. But the reason I'm asking, I've seen some foreclosures in like Texas. I mean, there's 120 buildings and units, and then they've got. So, what's the way around having interest only payments? You don't want that, right? As an investor, because then I'm guessing that's how these folks get upside down. So, and that's the question now. If there's a foreclosure on one, now this is a buildings built in 2008, so they're not that old. So how do you get financing for a foreclosure? Because it's as is sale when they do that. Does that make
There's
any
a,
sense?
yeah. There's a couple questions and a couple topics that are inside of the question that we can kind of dissect it and talk through. So the first part of your question was doing an interest only loan and getting in trouble because you're not paying the loan down. And I love that you bring that up because it directly correlates with the loan to value that they'll give us if we do an IO. We do full term IO. FTIO is what you're going to see in the term sheets, right? So normally they'll do up to 80% loan for you. But if you want to do full term IO, and like you said, Mike, not pay the loan down for the entire time, they're not going to give you 80%, right? They're only going to give you 75 at best. And if you only give yourself 5 years to a 5 year term, they're not going to give you more than 65%. So that's how you protect yourself when you're only doing interest only is you don't borrow as much, right? See, the problem is you're not paying the loan down during the term of the loan. So protect yourself by not borrowing as much and keep it at 65%. That way, when it is time to refi, you're not over leveraged. You're not upside down. That's the first part of your question is that's really the best way to protect yourself. Obviously, if you operate your plan right, you're going to increase the value of the property, but we have to guard against that because the lender is not banking on you doing everything right. The lender is more conservative, right? They're banking on protecting themselves in the beginning and then you just doing everything average. That's their mentality. So you're right. It can get you in trouble and you can end up over leveraged. That's why you don't borrow as much in the beginning. So it's a great point. The second part, hey, if you're buying a foreclosure, you got to go bridge with it. Well, okay. I say you got to go bridge with it because that's like the generic response. The first thing you're going to do is connect with the lender that owns the property now and see if they're open to doing financing for you, right? If you're coming in strong, if you have a really strong borrowing team and that lender wants to convert that asset from a toxic asset to a solid asset on their books, they may do it. A lot of times they don't because they just don't want anything to do with the property anymore. They want to be away from it. But there's a lot of banks out there that may consider extending debt on it if it helps them not have to write off as much, right? Maybe you can offer them a little bit higher price and they don't have to take such a hit if they finance it again, right? So there's going to be a give and take on that. And as always, right, we want to get, Susie talked about creative financing earlier or being creative earlier in the call. Most of the time, if you're looking to do seller financing, you're going to have to give somewhere, right? There's going to be a give. And you say, hey, I'll give you your price, or I'll get closer to your price if you finance it, right? So now all of a sudden, you're not as focused on your cost basis as you are having that seller do the loan. And that's something that I really, really caution everybody against or about and be aware of. We talk about getting creative, and creative can be great as long as you know what problem you're solving for. If the property's if the property's in terrible shape and you're going to end up having to pay 10 to 11% for a bridge loan and 3 points origination, but that seller will let you come in for zero origination and maybe a 7% interest rate for 2 years. Okay, now we're talking. Now we're talking. But if they just say, hey, we'll do seller financing, and you're like, oh man, this is something different. You don't just jump on it because it's a buzzword. You have to make sure that you understand what the fundamentals are and what the true benefit to you really is. Because so often somebody's like, oh, every deal I've done has been creative financing. Well, great. But what's available in the marketplace that could separate you from that seller and say, look, I'll give you a fast closing with my own financing, and you buy the property for $500,000 less. Now you're leaning into your overall cost basis. And we all know everybody's dad told us the same thing. You make your money when you buy it. Well, there you go. Bring your own financing, get a lower price, get rid of the seller. Hey, it's not creative, but man, the fundamentals are fundamentals. They work. That's why they last. When you understand how to read music, that's when you can start playing your instrument by ear and get creative with it. But you've got to know those fundamentals first before you start branching out and trying to get creative with stuff, because you really increase your risk profile when you do that. So kind of got off track a little bit, but on those foreclosures, we're going to use interim financing to buy it out of foreclosure, stabilize it, and then refinance into permanent debt.
All right. Just one more question. Am I still here?
You are still here.
You
You're
had just
still
talked,
here.
you had just talked about something that you have lender language. Where do I find that? Because there's a lot of stuff it goes.
Oh, you just go to the website, lenderlanguage.com.
No kidding. All right, that's
Yeah,
awesome. Thank you.
lenderlanguage.com.
Yeah. I don't have a team, by the way. I'm a one-man army.
Me too.
So this is
Well, Jerry's on my team on two deals.
right. Oh boy, I wish I had a Jerry or a Genie. All right,
Yeah.
thanks, Eric.
Yeah, sure thing.
Well, there are people here. Talk to them. That's why you need to put in the chat what you're looking for. I'm looking for a partner. Like, you guys need to engage with each other in the chat. That's how you guys get to
Yeah.
meet someone.
Yeah.
Eve
Yeah.
has a question. Go ahead, Eve.
And making sure I'm unmuted before I start talking. So, Eric, you had talked about approaching the lender when you're taking the current lender to see if they would continue the loan or um, redo the loan with the same lender. And that I've also heard that that is challenging to get the lender to close on those, and we've actually experienced that ourselves on or that it just dragged on because it's already on their books, and so there's not really as much of an incentive for them to close quickly on the new loan or the with the purchase. Have you seen that?
I
Um,
have seen it. Yes. It's, I will say that it's all challenging, right? Anything like that, when you're dealing with distressed assets, dealing with the sellers of distressed assets, dealing with the lender, it's all challenging because one, you've got attorneys involved. Two, they're hypersensitive to it because they have a problem. They're getting ready to lose millions of dollars. A huge component of that is they're going to get audited on everything they do. So they have to show, and looking at this, taking more of an empathetic approach from the lender standpoint, they're getting ready to take a huge hit. And they're going to have to answer for that hit because it was based on decisions they made when they originated the loan, how they monitored the loan during the process. And now it's all falling apart. They're going to lose 3 million bucks on this deal. Somebody's going to have to answer for that. So before they can just make a decision and write it off, like Seinfeld writes off produce, um, they have to make sure no Seinfeld fans. That's an awesome episode, guys. Come on. Thanks. All right. So
I like Seinfeld.
they just write it off, Jerry. So
Right.
um, everything is going to be looked at. Everything's going to be audited, and they have to show that they made best efforts to get the highest price for that deal. They want to see that the property was marketed. They want to see what those offers were. They want to know how long it was marketed for. And if you are willing to offer them a higher price and reduce that loss, if they are open to taking a very conservative debt position going forward, it doesn't happen all the time because more often than not, they're going to say, we are done with this thing. Get us out of here. But there is a chance that they're going to come in and extend debt to you. Now, you've got to show experience. You've got to show that you're well funded. You have a really solid plan in place. There's probably going to be an interest reserve involved. There's probably going to be a renovation reserve involved. And you're going to have to pay more for the property. But if that financing is attractive, maybe it works out, right? This is where you take all that data, put it into your spreadsheet, and then take the data from new origination, maybe at a lower price, put that into your spreadsheet, and just let the numbers tell you which direction to go.
okay, thank you.
Yep.
Well, Does anybody has question? Because we don't have a lot of time left. But one of the question that I have, Eric, is
Lance got a question.
who? Oh yeah, Len, go ahead. Ask your question.
Yes, I have a question like I want to offer one of the commercial plaza that right now they have on for sale for almost 2.1 million, but I want to offer them like around 1.8 million. But instead of below that, it have to be on recorded loan. So instead of that, can I uh, offer the seller, I pay them full price, but I want them reimbursed for me for like 300,000. So that way I will not have the below 2 million. What do you think? Stu?
Well, I think the first thing that you're going to want to do, if they're asking 2.1 and you're offering 1.8 and you're buying it from the bank, I think, is if I'm understanding correctly, or you're just buying from a seller.
From the seller.
Seller. So the bank's not involved.
Uh,
Is that right? Or is this a short sale?
no, it's just a regular sale. Like
Regular
yeah.
sale. Okay. Well, you're not that far off. I mean, offering 1.8 on a 2.1 a 2.1 asking price is not that far off. So making your offer and making the strongest terms that you possibly can, trying to steer away from the price and understand what value points that seller really wants to hit. Because I can tell you as a seller, certainty of execution for me goes a long way. A couple $100,000 in a purchase price is not more important to me than knowing you can close. So if you're willing to tighten up your contract terms and absorb more of that risk of loss of earnest money or the deal not closing for some reason, risking your performance, you should get a better price. Because I can tell you how many flaky buyers come to me and they're like, oh yeah, they want to do creative financing. They want to do seller holdbacks. They want, you know, they want a 60-day finance contingency, all the earnest money, no earnest money goes hard until the loan is, committed or something like that. Like I'm supposed to bear that risk of them being able to get a loan for the whole time. And then they walk in 60 days, right? That's a
Yeah.
weak term for me, right? So go in and strengthen the terms of your contract and move away from the money side and focus on the certainty of execution. And now you're going to hit some hot buttons for that seller they might really want.
I see.
All
So
right.
okay. Thank you, Steve.
Eric? Yep.
Okay, Len.
Thank you.
Thank you.
Thank you.
We don't have a lot of time for the purpose of this meeting. I think one of the questions, we have a lot of questions, but we don't have enough time. How should investors adjust their underwriting based on these changes?
I would like to see I'd like to see clients dial in what type of asset they're really going for, right? When we had the small balance and we had conventional, if one came in, we knew exactly which direction we were going to go. We knew the SBL program was right there. If you are dialing in under 30 units, now you know how you should underwrite that deal, right? If you really want to have that 10% minimum underwriting, minimum vacancy. And Fannie Mae doesn't do that, by the way, but Freddie Mac does. So understand that there are alternatives to it. And to Jerry Kong's point earlier, there's alternative lenders that don't underwrite to 10%. Now, that being said, I think it's a good idea because it's so easy to get to 10% when you're under 30 units. We're going to have 3 units vacant at some point. But that's a material difference in your underwriting. I don't think you should change your interest rate expectations. I think if you are a quarter point to a half a point away from that interest rate making or breaking your deal's too tight. You should be able to withstand that level of fluctuation because you're going to see the same impact 2 years down the road after you already own the property and your insurance rates get jacked up through the roof, you need to be able to withstand that, right? And that's something that we experienced 2 or 3 years ago. Insurance flew off the handle. I had deals where my insurance premiums have tripled over the course of a couple years, tripled over the course of a couple years. I repeat it because it's so impactful, right? It wasn't about interest rates. It was about payroll that had gone from 1,100 a door or 1,000 a door to 1,400 a door. It was about insurance that went from 375 a door to 875 a door, right? It went from R&M was just through the roof, right? Just because of all these inflationary pressures. Now that we see inflation pull down, what goes with it, right? We see some of the pricing cool off on our expense load, but what is a major portion of our inflationary measure? Shelter, our rents. What's happening now? Rents are flattening out.
Flatline.
So, I mean, you live by the sword, you die by the sword in this business. And there's a fine arbitrage there that you have to play. And that's why you pick your market properly. That's why you pick your vintage properly, and you pick your entry point into your deal properly. And I do not profess to be a guru at this. Like, I'm not one of the guys that has a big educational program or anything like that. I kind of stay in my lane with my little course. But
Right.
I tell you, it's not all about rates. Everybody who's waiting for interest rates to come down and think that the financing is what makes the deal. I challenge you to make the purchase price what makes the deal. Now's the time to do it because buyers are deciding where these markets are going right now. There's the valid buyers, substantial buyers that can perform are few and far between. And if you can bring that to the table, hold your pricing, you'll probably get it.
You're right. You are definitely correct on that one. Yeah.
Yeah, and that's
So,
a seller talking. That's a seller talking, guys.
this is how it started.
Yeah.
So, this is our last question. If you had to give one piece of advice to investors navigating this market, what would it be?
Hmm. Oh boy. One piece of advice, ask a lot of questions. Go get more advice. I have that if it look, it's the old adage, right? If you get three wishes from the genie, the third wish is always three more wishes, guys.
Right.
So if I'm limited to one question, it's going to be three more wishes.
I like this one. I like this one. Well, Eric, thank you. Thank you so much. That was really good. I think we needed to have, and that's what we meet every week. And just for us to know what's going on, to engage, to learn, and then to know how to move forward. Because right now we are working in that very tight um space, and there's so many other issues. Like you said, it's not just the interest rate, it's not just insurance, it's there's a lot of other elements and factors involved, and we need to understand what we're looking for in order for us to get what we need, what we want, right? So if we don't assess our needs or we don't assess the problem, we cannot find a solution. So I think that's what we need to do right now. And we always have to have a competitive edge to stay in this market, in the industry, because everything is evolving. Now we have AI, there's so many other things. So you have to figure out how you're gonna stay here and continue doing what you're doing. With
Can
that
I
being
share
said, let's
Susie?
have a quick
Wait, let me put my hand up on my side of my thing here. I don't know how to do it on the actual thing, so I'll just put my hand up there. Um, is it okay if I share two really quick
Yeah.
features from this?
Oh,
They're totally unrelated to each other, except they're all in the same
yeah.
program.
Oh
But
no, go ahead by any means.
one thing that you guys can hang on to for this small conventional program, the minimum net worth, whether no matter if your loan amount is between 2 and 5 million, they have a $5 million minimum net worth requirement. So typically it's net worth equal to the loan amount. But if you're getting a $2.5 million loan and you go small conventional, you still have to have $5 million net worth.
Network.
So you want to keep that in mind. And there was oh geez, there was one other thing, but I don't remember what it was. So that was it.
Yes.
There's
There's
going
no
to be
other thing.
a lot of discovery as we go through this.
Yeah, definitely. Can you guys put your camera on? We have a picture right now. It's picture time. Let's have our picture, and then before we leave, let me see if I can get a gallery. This thing is acting up. Sometime I don't even can get Zoom, figure it out. All right, there we go. So we're gonna have a picture. Sean, stop moving, please. So I can be in the picture. There you go. All right, picture time. Let me find mine. Go ahead. Cheese, everyone. Cheese. There you go. All right, we have our picture taken, and with that being said, hold on. I don't know, something happened. Well,
The
I don't
cheeks
see the
are
picture. Hold on, something happened. I don't know. We have to do it again. Sorry. Okay. I think I did something different. Did I try to read? Uh,
Thank you,
all right,
Eric.
there we go. There we go. We got it.
So,
Yes. What
so
did you say?
Eric,
Well,
Susan.
okay. Are you saying something, Lynn?
Yeah, I say thank you.
Oh, thank you so much for everyone for being here. It was such a great meeting. Thank you, Eric. And let's meet again next week. Most of you will see you at UP in the next 2 weeks. 2 more weeks, we'll see each other. Yay. So excited. Bye, everyone. Thank you so
you guys.
much. Have a
Bye,
good
everyone.
afternoon.
Have a
Bye.
wonderful
Thank you.
weekend.
All
Thank
right.
you.
Bye-bye.